The similarities between the housing market today and the housing market of 2007, just before the great housing market crash during the global financial crisis, are truly terrifying. Many key indicators surrounding the health of the housing market and where it is likely to head in the future are now lining up almost perfectly with that of the 2006 to 2008 time period. And in some cases, today's market actually looks even worse, leaving homeowners scared about what could be about to happen next. We all know that house prices have surged over the last couple of years, largely due to the amount of new money that was pumped into the economy as a response to the global pandemic. This can be seen in the Case-Shiller Home Price Index. However, this chart is not always the fairest way to judge whether homes are currently overvalued or not, as it doesn't take into account inflation. But when we factor in inflation over this time period, we can see that the growth in home prices has still vastly exceeded the growth of all other goods and services in the economy. This significant outpacing of home prices relative to inflation in the rest of the economy has now made home prices more expensive than the peak that we saw just before the global financial crisis. But it gets worse. Things start to look even more bleak when we take a look at the other key metric that determines housing affordability, which is mortgage rates. Thanks to the record-breaking surge in baseline interest rates that we have seen over the last year and a half as a result of the Federal Reserve's desperate attempt to control inflation, the average 30-year fixed-rate mortgage is now sitting well above 7% at around 7.29%. And looking back at the time period before the housing market crashed in 2008, we can see that this percentage is noticeably higher than what the average mortgage rates were back then, and easily exceeding the absolute peak of 6.8% that was seen in July of 2006. So not only are home prices way higher than what they were in the late 2000s, even when you factor in inflation, but mortgage rates are also significantly higher too. Taking all of this into account, the cost of home ownership is now far higher than any point in recent history, and Redfin data shows that average homebuyer housing payments for a median-priced home have now reached $2,616, which is about 16% higher than at the beginning of 2023, and this is also a whopping 80% higher than this time 3 years ago in 2020, where the average monthly homebuyer housing payment was approximately $1,450. It's clear to all that the cost of home ownership jumping by 80% in just 3 years is simply not sustainable in the long run, and something does need to give way. Redfin data also shows that right now home buyers need to earn $115,000 a year to be able to afford a median-priced US home, and the median household income in the US is about $75,000, which means that the average household can no longer afford the average price home, and by quite a significant margin at that. Even those that can afford to buy a home in the current market are having to sacrifice an enormous portion of their income. When we look at the national payment to income ratio, we can see that we've now exceeded the 40% mark for the percentage of income needed to make monthly mortgage payments on an average price home. And this ratio is now far higher than the peak of 34% that was seen during the global financial crisis, and you'd have to go back to the 1980s to find the last point where the payment to income ratio was this bad. The only way for this ratio to revert back towards more historical norms of between 20 and 25% is if we see a sharp increase in average income across the whole of the US, a major drop in mortgage rates, or if we see a significant correction in home prices. Now, you can all but rule out a major drop in mortgage rates, as the Fed has stated multiple times that they are committed to fully tackling inflation to get it back down to 2%. Jerome Powell has come out and said the central bank was not confident it had raised rates high enough to lower inflation to its 2% goal in the next 2 to 3 years, and we're trying to make a judgment at this point whether we need to do more. Many economists therefore expect interest rates to remain higher for longer, meaning that we are unlikely to see baseline interest rates fall by a meaningful amount anytime soon, which means that mortgage rates are also likely to stay elevated. And as for average income, it is estimated that by the end of 2023, the average annual increase in income across the US will be just 3%. Now, since 1960, wage growth in the US has averaged just above 6% per year, meaning that we are very unlikely to see a big spike in average household income that would be needed to correct the payment-to-income ratio to make housing more affordable again. And if anything, we are actually likely to see average income stagnate or even decline in the coming years if historic data around interest rates correlating to unemployment is anything to go by. Looking back across an extended period of history, there is a very clear correlation between interest rates and the unemployment rate, but with a lag of several years. This means that historically, as interest rates have increased, we have seen the unemployment rate also increase, but lagging behind by a few years. We've obviously just seen interest rates increase at a record-breaking pace, which started at the beginning of 2022. Meanwhile, the unemployment rate is currently at historic lows of 3.9% and clearly has room to start rising to a higher percentage while still being in the realms of normality compared to what we've seen historically. Based on this correlation, it is very reasonable to assume that we will start to see the unemployment rate start to rise in the next couple of years and ultimately end up rising quite significantly relative to where it is today. More people being unemployed would of course have a negative impact on average income and would be bad for housing affordability and also housing demand. Therefore, based on all of this, the only feasible way we could see a significant correction in housing affordability in the next 12 months would be for house prices to fall. With the housing market being so expensive and unaffordable for many people right now, we are seeing record low levels of demand for homes, with the demand for mortgages now being at an all-time low. And this dwindling demand for homes has led to the number of existing home sales being at a 13-year low. We're also seeing investor demand plummet as well, with many investors clearly concerned at the current health of the housing market. Investor purchases are down 30% year over year, and this marks the 5th consecutive quarter of declining investor demand for homes, the longest period of decline that we have seen since the period between 2006 and 2009. If this falling demand was matched with falling supply, then this wouldn't be such a problem for house prices. However, this is not the direction that housing supply is heading in. Looking at housing inventory levels, we have seen the supply of homes on the market stagnate and start to tick steadily upwards since 2021. And looking at the current number of housing units under construction, which is at around 1.7 million, this growth in housing supply is likely to speed up in the coming years as all of this supply gets offloaded onto the market by home builders. Now, this figure has been growing for the last decade or so and is even higher than the peak number of units under construction that we saw during the global financial crisis of around 1.4 million in 2006. And despite home builders collectively having a record high number of housing units under construction, home builder sentiment is certainly much lower now compared to when many of these units were started. In fact, US home builder confidence has dropped for 4 consecutive months and is now at one of the lowest points that we have seen for the last decade. In November, 36% of builders reported cutting home prices, an increase on the previous 2 months, and 60% of builders offered sales incentives of some type to new buyers, which was down slightly from October, but still a very high percentage and is a sign of how difficult the market is right now for those selling homes. Another concerning trend that we are seeing is rising housing foreclosures, with many more people struggling financially due to the cost of living. Foreclosures are likely to only keep increasing in the future as unemployment inevitably rises and people can't keep up with their mortgages. And on top of that, we are going to see more people who are forced to remortgage on a much higher rate than what they are on today. These foreclosures will result in additional homes being put onto the market through forced sales from distressed sellers. With there not being enough demand to match this surging home supply, this is not good news for home prices. So the housing market is certainly looking scary right now, but another very concerning thing is the growing US debt crisis that is threatening to cause the unthinkable to happen. I go into more detail on this in my previous video, which you can check out on the screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.